Hello and welcome to our new Wilkins Southworth video. I'm Chris Wilkins. At Wilkins Southworth, we always explore the problem to ensure that you get the most proactive and best tax advice.
While Bitcoin continues to grab the headlines, the cryptocurrency sector now takes in literally thousands of different digital assets. Even though Bitcoin dominates the sector, making up circa 40% of the market, more than 12,000 altcoins are available. This is a phrase used to describe the cryptocurrencies other than Bitcoin, with Ethereum the most recognized altcoin. Even though many people will be aware of the Bitcoin image, the gold coin with the B in the center, these are digital assets and do not physically exist. Consequently, how to tax crypto assets and cryptocurrencies is proving a challenge. The emergence of Bitcoin. The 22nd of May 2010 will be forever etched in the history of cryptocurrencies. The first commercial transaction. This was the day when computer programmer Laszlo Hanyecz spent 10,000 of the bitcoins he had been mining. He purchased 2 pizzas from Papa John's for a combined value of $41, with each bitcoin worth 0.0041 cents. At the current price of $62,000 per bitcoin, today the transaction is valued at a staggering $620 million. An expensive couple of pizzas. The price of Bitcoin has been highly volatile, currently just off its $66,000 high reached on the 21st of October 2021. It is easy to assume that Bitcoin and other crypto assets have been around for some time, but they have only been in the public domain for just over a decade. Until recently, these currencies were effectively ignored and rejected by mainstream regulators. Consequently, governments worldwide are now playing catch-up about both taxation and regulation of the crypto asset market. Regulating cryptocurrency markets. While the Financial Conduct Authority, FCA, the leading financial regulator in the UK, has been monitoring cryptocurrency markets for some time, it was only recently appointed regulator to the many crypto asset firms operating today. The FCA banned the sale of crypto derivatives to retail customers in October 2020. Then followed a dire warning in January 2021. Those investing in cryptocurrencies should be prepared to lose the full amount of their investment. This was the beginning of a concerted campaign amongst international regulators to rein in the power of cryptocurrencies, setting the ground for future taxation. The crypto platforms were forced to apply for FCA approval to operate in the UK. Under the guise of money laundering and anti-terrorism regulations, all crypto platforms will need to be FCA approved going forwards. As of June 2021, only 6 out of the dozens of firms have received FCA approval, with 64 applications recently withdrawn. It would appear that many cryptocurrency platforms don't currently conform to international anti-money laundering standards. We recently saw the high-profile quasi-ban on the Binance crypto platform, with the FCA banning the transfer of funds from UK-regulated banks to the trading platform. First came denial, regulation, and now taxation. The emergence of leading products and services has often left regulators struggling to keep pace. We saw the same process when electronic cigarettes first emerged: denial, regulation, and now taxation. The first 2 stages have been completed for crypto assets and cryptocurrencies, and now HMRC is taking a greater interest. The Financial Times reported that HMRC plans to send crypto investors what are known as nudge letters, encouraging them to check that they have paid the correct tax on their crypto assets. Receipt of such a letter does not necessarily mean you have underpaid your tax, but it is a subtle warning that the authorities are watching. There is a widespread belief within HMRC that large amounts of capital gains tax and income tax related to cryptocurrency investments haven't been declared. Through a publicly available Freedom of Information request, we know that HMRC is targeting crypto asset platforms in the UK and those on the international scene. Under their existing powers, HMRC have gathered information on crypto investors for the tax years 2017-18, 2018-19 and 2019-20. The information obtained includes the names and addresses of individual investors and the value of the crypto assets they hold. When dealing with traditional banks, details of the sender and receiver of funds are noted and recorded. Transactions in crypto assets are traded on a peer-to-peer basis under the blockchain system, which records all movements. Whilst this creates a very secure validation system, there is an element of anonymity to these blockchain transactions. However, additional details gleaned from the crypto asset platforms fills in the gaps. This has been one of the significant regulatory concerns: money laundering and the movement of terrorist-related funds on a quasi-anonymous basis. Taxing crypto asset profits. As of September 2021, it is believed that more than 2.3 million people in the UK own a crypto asset. As these assets don't physically exist, HMRC has been forced to issue guidance stating that crypto assets will follow the residence of the beneficial owner. So, if you live in the UK and trade crypto assets, no matter where the assets are held, you will be liable to UK taxes. However, there's a growing belief that this guidance may well be challenged in the courts. This could impact future HMRC tax income from those not domiciled in the UK for tax purposes. As a rule of thumb, profits from the trading of crypto assets will fall under the capital gains system. In certain circumstances, where HMRC recognises a sophisticated, frequent and organised investment operation, this could lead to income tax liabilities. When it comes to inheritance tax, the situation is even more confusing. Under current regulations, only assets located in the UK are subject to inheritance tax where the deceased held a foreign domicile. However, as cryptocurrencies are not physically located in the UK, there may be some legal challenges in the future. Those domiciled in the UK will still be liable to inheritance tax on all their assets, both UK-based and overseas. Regulators struggling to catch up. The current regulatory structure in the UK allows the FCA to regulate those operating in the crypto asset market, but not cryptocurrencies as such. In effect, it's the same, recently demonstrated when the FCA banned UK banks from transferring funds to the Binance crypto asset platform. The emergence of HMRC plans to send out nudge letters is a subtle reminder that crypto assets and cryptocurrencies in particular are on their radar. They are effectively allowing investors to review recent tax returns to see whether crypto asset profits have been included. Failure to make the relevant corrections could be deemed a form of tax evasion and lead to significant penalties. In what is effectively a two-pronged attack, international regulators are clamping down, and the tax authorities are inviting individuals and companies to correct any previous submissions. Subtle, but so far effective. But will we see any legal challenges? If you have any questions on the taxation of crypto assets and cryptocurrencies, please drop a comment below and we will get back to you as soon as possible. By the way, don't forget to subscribe to learn about other videos in this series.